Tell me, Kreskin, what am I going to say?
You're going to point out how the miners, and rightly so, are up quite a bit, although silver's up, I don't know, $2.5, $3 over the last couple of 2 days. Silvercrest is down, First Majestic's down. Hello there, my friends. Chris Marcus here with you for Arcadia Economics. And today, for this week's Denver Dave Kranzler episode, fortunately, Dave and I did a roundtable with Rob Kientz of Gold Silver Pros, who had his amazing North American Monetary Metals Conference this week. And Dave and I took questions along with Rafi Ferber and took a lot of silver questions about the silver mining stocks. How come they haven't gone up more? I know a lot of people are wondering. So Rob has kindly allowed us to share that, which is what you're about to see. And check out Rob's site. If you haven't seen the conference, he recorded a lot of great stuff. You can find that at goldsilverpros.com. So I guess Rob is our sponsor for today's show. And thanks, Rob, for that great conference. And here is the conversation.
This is Rob Kientz at goldsilverpros.com. You're at the North American Monetary Metals Summit 2020. We're at the August 6th, 12 p.m. live Q&A session. We have guest hosts here, Chris Marcus from Arcadia Economics, Denver Dave Kranzler from Investment Research Dynamics, and Rafi Farber, who writes for Seeking Alpha. Thank you, everybody, for joining. We'll go ahead and get the questions started. So I'm going to read off a couple here. Oh, actually, Chris, I think you wanted to start with the topic, right?
Say that again?
Did you want to start with your topic before we go into questions?
I did not have a particular topic. I'm happy to talk about silver, as you may know, but we can start with questions. And I know a lot of people I've been getting emails asking why some of the silver miners are not seemingly keeping up with the move. So perhaps we could dig into that at some point as well.
So that was, let's start there, because that was a question from Saeed earlier. Why aren't and Rennie also, why aren't the miners keeping up with the gold and silver?
I can predict Dave's answer, but I will let him go first.
What? Tell me, Kreskin, what am I going to say?
You're going to point out how the miners, and rightly so, are up quite a bit, although, you know, again, this is just one example here. Although, first of all, it's like silver's up, I don't know, $2.5, $3 over the last couple of 2 days. Silvercrest is down, First Majestic's down. And just, again, this is a crude comp that is highly simplifying things. But I look back to the end of last year. So December 30th of 2019, the price of silver closes at $17.93. And First Majestic closes at $12.41. Since then, silver is up $10.27, 57% return. First Majestic is up $1.23, so about a 10% return. So, you know, I think people might have expected the inverse, you know, silver to be up 60% if silver, or the stocks to be up 60% if silver moved a little. So I can, anyway, I'll let you take it from there.
What was your starting point, your starting date there?
December 30th of last year, so 7.5 months ago.
Okay. So what if you measured it from mid-March to now?
Well, obviously, if you take different points, you know, you can skew the results. I would suggest that, at least the way I'm looking at it, mid-March, when this price of silver went to $12, is more the anomaly where, I mean, yes, you know, you can, worthwhile to look at how much things have gone up, but I mean, that seemed to be a blatant hatchet job with the paper contracts. Well, every measure of retail or wholesale silver was that there was massive demand. So when people measure things from the lows in March, I mean,
The First Majestic's tripled since the low in March.
Right, but what I'm saying is that I don't know that. To me, okay, that was an anomaly. March, to me, it's a more valid comparison. Like if you look at several points, whether it's last December or even last September when silver was at $19. So I would use that.
You can always cherry pick your time starting points. I mean, let's just look at, what AG did and what silver did from January 1st, 2016 to mid-July 2016. I mean, AG ran from and I don't know if it was that exact time frame, but it ran from like $2 to $19.
Correct.
And then it got hammered.
18.
And so silver didn't have anywhere near that kind of return. So, the way that I look at it is, theoretically stocks are supposed to be a discounting mechanism, right? They discount the future. So when a silver stock moves up, it's going to discount. It's going to move up more quickly than silver. It's going to anticipate a big move in silver, right? And that's not true anymore for the general stock market because the Fed has intervened so much. But the mining stocks, other than maybe intervention from time to time to hit them, they're not intervened. So I think it's probably the sector that has the best theoretical discounting mechanism. So you've had a big run from 450 up to 1350 in First Majestic, and I agree. First Majestic isn't as high as it is now as it was in mid-July 2016 when silver hit 21 or something. I don't remember the numbers off the top
Dave,
of my head.
Can I give you the numbers there so you can have it in context? Well, and then because I have it pulled up here. When silver went from $14 to a little bit over $20 in 2016, you had First Majestic go from 3 to 18. And to be clear, that certainly could be aggressive. I mean, I'm not saying that's the right comp, but just to put it in context versus if you look from the beginning of the rally last year, which was May of 2019, First Majestic is $6. So now we've had silver go similarly from about $14 and it's doubled to $28. Yet this time First Majestic has gone from 6 to currently 13.5. So, again, not that it has to go to the previous levels, but at least compared to 2018, or 2016, you had silver move $6. First Majestic went 6x. Here, silver has moved from 14 to 28, and First Majestic's doubled when, on a cash flow basis, looking at their all-in sustaining cost, I think it's around 13 or 14 bucks. So, if you have silver go from 14 to 28, if you call their profit margin $1, it's gone up 14x. Just seems like a much bigger move in silver, and so far.
So, okay, let me just jump in here. First of all, the bloom is off the rose a little bit on First Majestic. I haven't looked at the numbers deeply for a while, but I think they may be depleting silver now faster than they're replacing it, unless they do it by replace it by acquisitions. And I had always considered First Majestic had been kind of I used to call it a newsletter darling, and I always thought that it was always overvalued relative to its underlying fundamental value. And I'm not saying that's a bad thing, but so you had a rapid run up in 2016 in a 6-month period, and then a crash essentially in the price. And I would argue that investors are probably a little more cautious this time, and you're not seeing the massive rush of capital of hot money into the sector like we did for the first 6 months of 2016. I actually like the fact that some of these stocks, and these stocks haven't been lagging. I mean, I think that's a misperception. It might be lagging if you jumped into these things in mid-June thinking they were going to go a lot higher. Well, by mid-June, they had already discounted the move we're seeing in the metals. So I would argue that the metals are kind of playing catch up to where the stocks have already set the expectation, right? So yeah, let's just use gold. So mining stocks have priced in $2,000 gold. They priced it in by June or mid-June maybe. So they're starting to go up a little more slowly. There's some caution. There's profit taking, technical mumbo jumbo. So now the question is, when are the mining stocks going to start discounting $2,500 gold?
Can I jump in here for a minute?
Sure.
Well, I want to take this a little bit more down to the human level. I mean, I have a cousin who works at the Comex. His coworker is actually in charge of the gold futures product GC. So I argue with him a lot, and he keeps telling me this is just like 2008. The Fed's gonna print us out of it, and everything's gonna be fine, and the dollar's not gonna collapse. And that's pretty much what the big guns of the Comex and the big financial institutions, they believe, at least outwardly. And I think that is what is going on in the relationship between gold and gold stocks and silver stocks. I mean, what I think is happening is that people expect gold to eventually fall when the Fed gets this situation under control, but they are wrong. They're not going to get the situation under control. The dollar is in existential danger. So I don't know what's going to happen day to day or week to week or even month to month, but eventually I do believe, and I think I would say roughly within 2 years, and I could be wrong about that, but it's about 2 years, the recognition moment that the dollar is falling and it's not coming back, and gold is not going to fall back down again like it did between 2011 and 2015. It's not happening. Once the gold and silver stock investors understand that this is a new reality, then I think the mining stocks will be fundamentally revalued to the upside. Because if you take back in 2011, gold stocks were much higher when gold was only at 17, 1800. People still don't understand what's going on. But I think during the next correction, when gold falls, and it's going to fall, I'm pretty sure. I don't know how much, maybe 1900, maybe 1800, maybe even 1700. Once it falls there and it bottoms much higher, and at a level where mining gold and silver is still very profitable, then there's going to be a recognition moment, and the gold stocks and the silver stocks are going to take off.
Yeah, if I may comment on that. First, Rafi, I'll talk to you offline. I would love, if it's possible, to get in touch with, I believe your cousin, you said. I'm going to be heading to New York area in October. Would love to get on the Comex, talk with some folks there. But to your point, I think it makes a lot of sense because, yes, if, for it really to be meaningful to the companies, they have to be selling the metal at those levels for a while. So, and I could imagine a lot of people similar to 2016, probably the ones who still have a memory of 2011, where, silver actually stayed in the 40s and 30s longer than I think most people would remember. Yet still that peak up to $50 was a little bit short-lived. Certainly in 1980, in fact, in 1980, things actually went up and down quite a bit quicker than 2011. So I think that factors in, and there's something I've thought about a good bit in the past year or two, where when these things really do start to move, the majority of it is probably going to be priced by people who know infinitely less than anyone on this call. And I'm not trying to say that in an arrogant manner, but you're going to you have money coming in from the mainstream for the first time. Dave remembers my joke that I've said on the show before, where I imagine, some of these hedge fund and bank desks are like, hey, Bill, what's that thing that's up? Glod, what's that thing up 20% today? Oh, gold. And it's like, you have people that are just going to be piling in. And it's, I guess what I've been mentioning to some of the people who emailed me this morning saying, how come they're not up more? Maybe a more direct example, it's odd to me that silver's up $2.50, $3 over the last 2 days, and Silvercrest is down 90 cents. Yet, probably takes things a while to sink in. Things are moving quickly. Like Rafi, you pointed out, I think a lot of people are expecting a correction. Not everybody has read Dave Kranzler's great chapter in the book, The Big Silver Short, where he lays out, as well as 15 other experts, why I don't think it's an accident what's happening now. And there will probably be days where, silver's down 50 cents or $1. Maybe the market's rallying and you'll see big rallies in the mining stocks. So in terms of a poker analogy, it's like sometimes you get unlucky on that last card, but you play long enough and those things usually sort themselves out. And that would be my guess of how this will play out as well.
Yeah, I mean, the thing is, and I get emails every day from subscribers. In fact, I just got a text from a good friend and colleague of mine. Seems like the stocks are being hit, unnecessarily relative to gold and silver. They're lagging, and it's like, well, you're cherry picking your data points, because I can think of dozens of days over the last 20 years when the mining stocks, the Huey index, has been up 2 or 3%, while gold and silver are down. There's nothing written in stone that says, the mining stocks and the metals have to move in 100% correlation, and they're not going to. And there's, again, there's a degree of market expectations built into that both Rafi and Chris touched on, where people remember what it was like in July of 2016, and so there's going to be a little more hesitancy and caution. Bull markets climb a wall of worry. I mean, it's kind of a trite adage, but it's true. And quite frankly, I don't want to see the mining stocks go straight up. Yeah, would I love to buy a stock at 2 and it goes to 20 in a week? Sure, who the hell wouldn't? But if we want to have a long-term sustainable bull move, unlike what we had in the first half of 2016, I don't want retail stocks investors in this thing yet. I don't want Robinhood discussing mining stocks. I don't want mining stocks discussed in the mainstream media. Let everyone, that already understands it and knows why we're investing in this sector for the long term, let them get in and accumulate a lot and enjoy the gains when the, mainstream investment world finally discovers the sector and piles into this thing, because that's going to be your exit strategy.
So glad you brought that up, Dave. There is a question. I've had it earlier this morning before you guys jumped on at the 12 p.m. hour. And also we have it on the app. What is the exit strategy for precious metals? How do we know when it's time to get out?
That's interesting. I have a view on that. And this has been my view since 2003, after I felt like at the time I'd gotten pretty well up the curve in terms of, all the factors why you should be investing in physical gold and silver and supplementing that with mining stocks. And I mean, ultimately, and I think what Rafi was talking about touched on it, at some point there's going to be a global monetary reset. Mm-hmm. And we don't know what that's going to look like, who's going to trigger it, which countries are going to be involved, which countries are going to fight it, blah, blah, blah. But there will be a reset, and it's going to reincorporate gold and silver into the monetary system. And when that happens, the price of gold and silver will be fixed, so that whatever currency is the reserve currency can be easily convertible into gold and silver. Well, the price that they fix that at is going to have to be at like many multiples above where the price of gold and silver are right now. And so, when we get to that point, you'll be indifferent between holding, the currency that's created and backed by gold and silver, or holding gold and silver, right? So in 1933, before FDR did what he did, you were indifferent between holding dollar bills or 1 ounce silver coins, right? Because you could take those bills to the bank and convert them for silver coins. Well, I think that's what the world's going to look like at some point down the road. I just don't know when or what the price levels will be.
Yeah. So along those lines, the general answer that Dave, that when do we know how to get back on a gold or silver standard or some kind of hard money? We've been talking in this meeting from a dollar standpoint. We're still dollar centric, and even I am. I mean, I look at my account and I look at how many dollars it's worth. I still don't count my wealth in terms of gold and silver ounces, but that's going to change, and that's the mentality switch. That's the mental switch I try to train my subscribers to be prepared for. I mean, when silver was money, I mean, when it was really something you traded monetarily for goods and services, the gold silver ratio was pretty much 15, 16 to 1. And it was like that for hundreds of years. But then
Thousands.
monetary demand for silver went to zero because nobody exchanges silver for goods and services. They use it for investment. There's ETFs, buy coins and bullion for investment purposes. That's not monetary. But once the dollar really does collapse and if we have hyperinflation, which I think is coming, Mises said it's inevitable. If this is how you treat your monetary system, it's coming. Then monetary demand for silver comes back because most people won't be able to afford gold and they'll have to buy silver.
Exactly.
And they'll have to exchange that for goods and services. And then you'll see a fundamental revaluation between gold and silver towards the 15 to 1 ratio, which we hit in 1980 when there was a real dollar panic. And we hit it again. We hit it first in 1919. And then we hit that ratio again in 1980, and that's what is going to return. I mean, if gold hits, let's say 5,000, then that would put silver like 333. If it hit 10,666, these numbers are meaningless though, because when the dollar is worthless, you're going to be paid in the actual gold and silver dividends that these companies are digging up in some kind of paper certificate.
Actually, speaking of which, Dave. Like, let's say we get to the point, world's still intact, and you have, we don't have to get to the point where we have $2,000 gold, but let's say we had $2,000 gold and $50 silver for a couple of years. A lot of these companies are going to be making a lot of money. Do they start paying dividends again soon? I mean, it seems like, it doesn't feel like there's that many. I mean, I'm assuming there will be a lot of takeover and buyouts, but I mean, it's like at some point, are they going to have so much cash that they'll have to give back dividends?
I mean, I guess so. I mean, that doesn't seem to be the norm on the New York Stock Exchange anymore, right? They just issue debt and buy back shares and say, we're returning money to the shareholders that way.
Well,
but
Dave,
I mean, there's some of the large mining companies pay pretty good dividends. I mean, I don't look at the gigantic miners, so I don't know and I don't care about dividend yields, but I want total rate of return. But yeah, no, and I do. I mean, I can't remember how long ago, and I don't know if First Majestic is still talking about it, but I know they've talked about paying a dividend in silver coins. So, Homestake Mining paid its dividend in gold. So I do think at some point we'll get to a point where these mining companies, I don't know if they'll mint their own coins and send them out as dividends, but I think we'll either see dividends being paid in silver, fractional gold, or fiat currency, which I guess you can accumulate those and then convert them into metal.
Silver's at 28.30 right now. Just wanted to point that out.
Rob, could we talk even about? I see there's a lot of platinum questions in there, and the idea of a platinum dividend makes me feel warm and fuzzy. So,
yeah, platinum, I think, is one of those undervalued metals, much like silver. It's underappreciated. It was used predominantly in catalytic conversions for a long time until we really discovered how well palladium could do. It actually does a little bit better. Palladium has a little bit higher stress tolerance for heat. So palladium has substituted for platinum in a lot of gasoline engines. So palladium has risen. Rhodium has risen. Rhodium's also used in auto catalytic conversions, by the way. So just the demand, especially like from the Chinese market for automobiles, has pulled up palladium and rhodium. And platinum's been sitting here saying, hey, guys, look at me. And it's the ultimate substitute for palladium and auto catalytic conversions. So if we continue to see these prices on palladium, I think some of that demand is going to come back for platinum. And I've long speculated that if we ever had a gold shortage, we would see some monetary demand for palladium and platinum, although I don't think we've definitely seen that yet. But I could see maybe some investment demand coming in for platinum, being as I think it's undervalued.
I don't think it's possible to have a gold shortage because gold isn't really used other than for fillings. And I don't even know if they use gold for fillings anymore. It's not really, it's used in jewelry, but only tiny amounts. Every ounce of gold that's been mined since gold has been mined, other than the stuff that's in people's teeths in graveyards, is above ground. So you won't have a shortage of gold. What will happen is the price will adjust to balance out the supply and demand. In terms of platinum, rhodium, palladium, for me, they may or may not be undervalued, but they're basically for industrial use, right? Catalytic converters, and I think military usage. I think they're used in weapons systems, but they're not monetary metals, and that's why I've never really had a definitive opinion either way, and it's why I haven't sort of branched out to look at palladium and platinum and rhodium. And I'm sure from a supply and demand standpoint and an industrial demand standpoint, I'm sure they're undervalued, and I know that there's efforts in the futures markets to try and manipulate the prices. So, but for me, they just don't fall into the category of monetary metals. So I don't really follow them or invest in them.
So one real quick mention for anybody that's interested in platinum, palladium. Tomorrow at 1 p.m. Central Time, we have an interview with somebody at Aether Catalyst Solutions. Aether Catalyst Solutions, and this is going to affect the demand for both platinum and palladium moving forward. They have developed a substitute using base metals and technology in catalytic conversions instead of platinum and palladium, and there's about a 90% cost reduction. And they've got two major OEMs, and I know who they are, but I can't say who they are. They're interested in their product, and they're in the final stages of developing that. They've got their lab certification done, and now they just need to do some final tweaks to get that approved. And when that comes out, this company is going to hit big time, because if you can use base metals instead of platinum palladium in that auto catalytic market, it's going to save companies a lot of money, and it's going to solve a lot of the problems we've had with getting platinum and palladium to market. So once again, that interview, 1 p.m. tomorrow, Central Standard Time. Don't miss that one if you're interested in platinum and palladium.
Rob, may I share a platinum observation that I've had?
Sure.
Platinum is the adjective or the noun?
Dave, don't get too clever for me today. You guys got to break it down. Remember, I went to public school, so easy
So
on
did I.
my friend. So again, I won't claim this as any sort of proof or conclusion, but just something that I find interesting. I was fortunate to interview Bart Chilton, former CFTC commissioner, shortly before he passed away last year. And one of the things that stood out to me is he mentioned when he was talking about, he did confirm JP Morgan took over Bear's silver position. He didn't specifically say it was a short position. I'm pretty confident it was. And what was interesting, he mentioned the combined position was over the limit. He gave them a waiver to reduce it. And over the next couple months, they came back, they had made it larger. And what's interesting is that when people talk about when silver went from 21 to 9 in 2008, or when gold went from 1,000 to 700, I don't know if I've ever heard, even in the metals community, anybody explain that other than panic selling. Yet I don't believe that's the case, because Bart confirmed, he was only talking about silver, but talks about how JP Morgan was making their position larger. This is as the Fed was doing historic interest rate cuts. It was a reason silver went from 13 to 21 between September of 2007 and the failure of Bear in March of 2008. Over those 6 months, the Fed cut interest rates 225 basis points. Just to put that in context, ever since March of 2009 until they started lowering rates again, 10 years later, they only raised 225 points. So you had the Fed going wild, you had Bear Stearns failing, you had Lehman Brothers failing, you had people buying metals. Yet in the face of this, the price of silver goes down more than 50%. And by November of 2018, to me, what was the smoking gun was that dealers couldn't find silver. The mint went offline in the US, in Canada. Miles Franklin thought they were going to go out of business, because here it is, normally when the price goes down, something's being flooded with supply, yet they couldn't get product. When the mint finally comes back online, Comex says $9 for silver, and the mint tells Andy Schechtman, here's your Eagles for $17.50, and you can add your markup on top of that. And what really stood out to me was when I actually went back and looked at the price chart. Silver had been going from 13 to 21 bucks, and it wasn't a little while after the deal. It happened 2 days. You have the Ides of March weekend, March 14th through 16th in 2008, and then that week, silver starts plummeting right as you have the takeover. So again, also that week, the Fed did a 75 basis point cut in one shot, which I believe at that time was the largest interest rate cut in one instance. Of course, they would go on to blow that away and make sure, you just cut rates to zero, say you're never going to raise them again. But how this connects with platinum, I will pull up a chart here. Oh, my screen sharing is disabled. But if you look at a platinum chart, it just seemed that after I had gone through all this and saw that platinum hits its all-time high of, I see as high as 2250-ish, 2 weeks before that bear
bring it up,
stern.
Chris.
What's
Go ahead
that?
and bring it up. Go ahead and share screen.
Okay. So here you see the platinum chart, and it just happens there, the peak there. I'm getting 2242, 2 weeks before that deal. And now in these Department of Justice guilty confessions, in addition to gold and silver, there are traders who acknowledge spoofing the platinum and palladium market thousands of times over this time period. Being a former equity options trader, I've noticed generally the smaller and more esoteric a market, often the more shenanigans that go on there. So again, it's on my list to dig into more, but when I saw that, and then it's 2,300, and what's platinum today? I don't know if it's back over $1,000 yet, but just something that really stuck out to me.
I have another question I wanted to ask that came from the app. People are asking about ETFs and the leverage ETFs. What do you guys think about those?
Dave?
Well, I mean, I'll jump in. I've always said that the leveraged ETFs are good ways to leverage an index on a short-term basis. The problem is, and I mean, the math behind it's kind of complicated, but like those 3 times leveraged ETFs, they lose 10% a month in time value decay because of the derivatives that are used to create the leverage. So in addition, you have to have a big move in a sector in a short period of time to do really well with those ETFs, because you're already swimming upstream with that 10% time value decay. If you Google it, there's an article that was published about it. I don't know, 7 or 8 years ago, maybe not quite that long, where the guy runs through the math on it. So, and actually, I thought it was interesting that the sponsors of JNUG and Nugget took those down to 2 times leverage because they had trouble hedging them. So, I think they're good for, if you want to use them to hedge or to speculate, but on a short-term basis. I wouldn't hold on to the 3 times leverage ETFs on a short-term basis. The ETFs like GDX or GDXJ, I mean, those are fine ways to leverage, to index the sector generally, and you'll get the benefit of a bull market, but you'll miss out on the the upside from actively managing your portfolio holding and the type of upside that you can get from individual stocks.
So Rafi, you're in our presentation around owning physical metals. The question we had was, what do you think about ETFs and leverage ETFs? Are you in favor of, or are you in favor of the physical metal?
Depends what you want to do.
Mm-hmm.
I own physical metal because I don't pretend to know exactly what's going to happen when the currency system fails. I have a family to take care of, and I want money to be able to exchange for goods and services that I'll need if the monetary unit where I live isn't working. So yeah, you should, for your own personal safety, just like you should own a gun, if you're into home defense, you should own silver because you'll need money to buy things. And you might not be able to with your paper money or your dollars or your shekels or whatever it is that you have. But if you want to leverage the silver price, then I don't use leveraged ETFs that much at all. I mean, USLV was a 3x leverage ETF by Credit Suisse, and it got discontinued. These things that they're not worth it. I mean, you might make some victories, but then once you have your first major victory, you go, oh, like I'm a genius, and you'll try it again, and then you lose everything. That's how these leveraged ETFs they kill you. But if you want real leverage to the silver price or the gold price, I mean, I would use leap options. That's what I do. I look at the 1978 to 1980 market, and I say this is what's happening now. Except now it's even more extreme, because back then the national debt was much lower. It was serviceable even at 20% interest rates. Now it is not. So we're going to see a 1978 to 1980 catastrophe. This time it's not going to be able to be reversed in gold terms. So I would take GLD for instance, and go out as far to the money as you can, as exists in the options table. I think the maximum is like 320. Go out to like 2022. I think the latest is June 2022, and buy $1,000 worth of options or whatever small change that you can, maybe 1% of your portfolio or something. Put it in those leaps, and then if I'm right, you make like $1 million or two, which you can then exchange for physical gold before everything collapses. And if I'm wrong, you lose $1,000. I mean, I think that's the way to play leverage. It's much less capital than these leverage ETFs that can mess you over.
Okay.
Yeah, if I can offer a comment there. First, I will paste a link into the window. I haven't read this one, although I think it explains the basic math on those levered ETFs. I'm not getting this exactly correct, but it's something like, when you're compounding, the difference between going up 10% and then down 10%, as opposed to down 10% and then up 10%. Like Dave said, there is a decay towards zero. So generally, if you're long the metals, you're long one of those levered ETFs. If you're timing something over a couple of days, I find they can be good there. The main thing I would say is dig through those and make sure you know how the math works. I mean, I like to look at it. There's no good or bad. That's what we call it. I mean, if you're getting clobbered from the long side, then perhaps it's mispriced and it's something you want to short. Again, but it's one of those things where I'll tell you what, if you had a good opinion on the metals and you went through and you understood the math properly, probably you actually could come out ahead, because most of the other people trading it probably don't understand it. But yeah, it's a different animal there. Although, like Rafi said, again, my background was in option trading. And in 2011, kind of how I got started in all this is that I had options on GLD and SLV, which if you time it on the way up, it can be a lot of fun. If you have your position and still hold it on the way down, it's less cuddly. But as I've been thinking about and it's nice at least having that experience from 2011, as I've been thinking about how to approach things now. And it's like, the more I think about it, the more my intuition keeps coming back saying, probably the less I trade, the less I try and get clever in the long term, the better off I'll be. Although with maybe one caveat to that, maybe if you took 90% of, and like Rafi said, you have your bullion. Obviously, bullion versus a levered ETF, let alone options on a levered ETF, are the two opposite extremes of the risk spectrum. But to the degree, if maybe, or I won't speak for anyone else, but myself, I don't know if we'll see how good I hold to these percentages, but if I had like 90%, you just have bullions in stock and you just leave it there. And I assume if I'm right about the price of bullion going up, they'll be fine. But maybe taking 10%, even if you took 10% and completely burned it down, I think what you would benefit by going through that experience and just giving yourself the freedom to try and, it's like I like that adage where if we never did anything until we were great at it, we would never do anything. So I mean, it's a really exciting situation. And if you say, all right, I'm going to take X amount of money, whether it's putting it on long-term options or any strategy, and just I don't know that there's any other way to replace that. And when you have, if we are headed towards something like 1980 or 2011, it's interesting because it's kind of a very unique, special experience that you can't go to the arcade, put your quarter in, and get exactly this. Maybe it's like when someone gets to the Super Bowl. Maybe you have that chance once or twice in your life. Most people never. So, you know, just having some guidelines in place. When I hear people say, well, silver's gone up too fast, it's going to correct. It may well correct. But if you say, well, just because it went up to 24, I think it's going to go down to 22. I mean, we're talking about the most manipulated market in history. And let's say you sell it at 24 and we saw it went straight up to 28. You leave yourself with a challenging decision there that, especially like in poker, as they say, you're on tilt. If you wake up, you see the thing just gapped up $4 and you're, you know, losing your cool and smashing stuff around the apartment. Again, I say from past experience, you know, then are you going to say, start making decisions that are different than what you would do with a calm plan in place? Dave, maybe if you have any thoughts on that. I mean, I know you have a lot of great trading experience. It just seems like there's a lot of decisions that, you know, unless you really have a good protocol in place for that beforehand, the degree to which, or I don't know, if you're a great technical analyst and you really know when you can tell when it's going to get hammered, by all means go for it. But Dave, I'd be curious your thoughts on that.
Chris brought up a good point. I mean, yeah, silver ran up quickly in a pretty short period of time. I mean, I've been looking for the market to correct since silver jumped over 22. Now it's at 28. And the moral of the story is, yeah, sure, we are going to get a corrective pullback at some point, but you don't know what the level's going to be. And charts can't tell you that. These guys that say they're, expert chartists, that's nonsense, because the charts have been telling you to sell gold, silver, and mining stocks now for several weeks, and yet they just keep going higher. I mean, if you're worried about it, just put some trailing stops into your positions. And then if you get stopped out, hopefully you're in front of the screens, when they sell off, so that you can reload your position. But we're in a long-term cyclical bull market here, and I think James Turk probably has the best strategy. And I wouldn't even buy the ETFs. Just buy a little bit of physical gold and silver every month, and that way, and don't worry about what the price is, because some months you're going to pay more than the previous month, and some months you might pay less than the previous month. But over a 12-month period in a bull market, your position is going to be worth a lot more than it was at the 6-month period or the 1-month period when you started buying. So that's the advice I would give.
Yeah, and kind of like, go ahead, Rafi.
Sorry. How I try to handle this with my followers is, I know some of them need to trade and they need to exercise that part and make them feel good about themselves. They can trade, and I also need that. I need to think that I can outsmart the markets, and sometimes I can't, sometimes I can't. But I try to give them some kind of outlet, I say, look, take a core position, buy these stocks, hold that until we get either a gold standard or hyperinflation, and do not touch them. Okay, 10, 20% above that, or whatever you want to play with, I'll give you buy, sell recommendations when I think there's going to be a correction, and we'll play around with that, and we'll try to make ourselves feel better, and it'll be great. And then if we're wrong, I have the leaps, the SLV and the GLD leaps. That is also a long-term hold. I just buy them every 2 years, and until I win, and that takes care of the upside leverage if I need that. And that way, I try to satisfy all of the emotions that humans have when they're trying to trade markets.
Got a quick question.
Of course, the silver bullion, of course, you can't just go to a coin dealer and sell it every day. It's like once you have it, you have it. That's it.
So on that silver question, we had a question from the app about, is there a conservative time frame to expect triple digit silver? And I think this is on the heels of Eric Sprott, I think, calling for $110 silver recently. So Chris, you had your hand up.
Yeah, I'd love to. I'd love to take that one. I am pulling up a chart if I can find it here, because along the lines of what Dave said, and I will have some numbers here in 1 second. You know, Dave, as you were mentioning that, it kind of reminds me of Tesla, where, you know, this beast that doesn't make money. And I wonder, I mean, if their economy just got shut down and destroyed, yet Tesla stock is soaring, are we in an economic depression? Or who's buying all of these Teslas? Yet, as Dave pointed out, thing is, these things can go. They don't, and similar with the mining stocks, it's not going to go based on what the cash flows are priced to, but to the decimal that day. It's kind of like when the Fed, I love, you know, they talk about, you know, the economy's overheating, so we're going to buy this amount of treasuries and we're going to tweak inflation 1.3. Like Bernanke couldn't even see the housing bubble when it was coming. And the idea that they're calibrating these things so perfectly. Similarly with the metals, you know, I've heard a lot of people say silver is going up too fast. It's got to correct, and it may well do that. If we look at, where is this one, you know, where you see price just drops whenever there's a big pile of metal just tossed on there. And, you know, some people say, is the manipulation over? Well, silver's still $28, so I don't think that's free market pricing. I mean, maybe they're losing the grips yet to the degree that, you know, you can still have these metals pounded. But at the same time, you see in 1980, which again is not to say that it has to follow that pattern, but you look on the way up here, I mean, it's climbing throughout the year. And when it was last week when we hit $24, I was curious, you know, how long it took. Here you see December 24th is when the close is over $24. And you look how quickly, if you want to take a quick guess, here it is, January 18th, less than a month later, when it hits its peak, over $49. So, you know, you can have someone come out, hammer the metals today and probably go down a bit. Or, you know, given that Fed's balance sheet over 7 trillion, now Steve Mnuchin's talking about more stimulus, you know, there's also the chance, we don't know if tomorrow they're actually going to send Bernanke out in a helicopter with a handful of hundreds. I mean, that's really the only thing the Fed hasn't done yet to this point. So I guess if there's a takeaway there, just something to keep in mind. I think we're at the point where a lot of, when I hear people say this has to happen or this, I don't know, silver could be, silver went up to 50, from 20, doubled from 25 to 50 in a month before. So I wouldn't sell that put at zero. I wouldn't also mortgage things or sell a kidney to bet on it. But I mean, also, you know, you see a run going on in the Comex, the amount of metal that, actually, I think I have this one pulled up here, the amount of metal that is allegedly being deposited into SLV. The folks I talk to say either
Silver receivables. It's not actual physical silver.
Right. So it's like, I could handle if the numbers are completely fraudulent, but at least you look at what they're reporting. I mean, that's going vertical like the silver price. So I would just perhaps allow that, you know, and if we're really, somewhere in the last week made me wonder, it's like, are we really, we could be close to seeing some sort of force majeure. It's different than saying we are close, but at least when you see the way these metals are moving now and the numbers that they're putting out there, I mean, at least to me, it's entering the realm of possibility that we could now be in that phase. We'll see how it plays out. And yes, sir, Saeed, did I say it correctly?
Yeah, that's right, Chris. Firstly, thank you. I follow you on Arcadia Economics, and I actually subscribe to Dave Kranzler's newsletter. Thanks
Oh,
to
thank you.
thanks to your interviews, or should I call them discussions, if I may? um,
Ramblings, Fed jokes,
yes,
something like that.
I just on that point on force majeure, and I've been following Robert's discussions on YouTube on force majeure with interest. I'd like to ask specifically both Chris and Robert, what are the key dates coming up for Comex in the next few months that I need to be focusing on? Is it the delivery dates or the expiry dates of the futures? And could you highlight what are those dates that are coming up that we need to be looking at, please? Thanks.
Rob, you want to go first, and I'll pull up a few links while you do.
Sure. So what I look at is I just look at the metal delivery notices, because those are notices intent to take delivery of metal and what that trend is. And of course, not all of those notices, are gonna, I guess, accept that. Dave Kranzler may actually know more about that than I do. But when you see these trends spike up and people saying we want the physical metal, then to me that becomes a real market. And that's a month by month thing. So I follow the trend over several months, and it resets every month. So you go 2 days before the first trading day of each month, you can start delivering those notices up until the day before the last day. So those are really the dates. And then you just trend it and you say, okay, is this going up? Is it going down? What percentage is being delivered? And that's what I follow. It's just sort of a general sentiment indicator to me, how many people really want the metal. Because the more metal that people actually go out and want versus all these other derivatives, the more interest people have in actually acquiring that. And they're not just playing off of the price, and they're not just playing for leverage. So that's what I follow. And Chris has got the CME Group's report here, so you can look at the delivery notices daily, monthly, year to date, and they'll tell you how much people are coming in daily. And you can almost correlate the spot price of the metal to what you see on a daily and a monthly basis. When you see a video I did, I think yesterday, we saw a spike in silver, like 1,000 contracts came in. Was it on the 4th, I believe, wanting physical silver, and then the price spiked on the 5th. And it's almost, you can just see that as an indicator of where the price is going. Open interest is certainly sort of a more aggregate indicator. It tells you how many positions are being taken, but those could just be cash settlement positions or just, your general long and shorts.
Yeah.
I would just like to point out, though, I mean, there's a difference between Comex delivery and a bona fide delivery. So a real delivery event occurs when the entity taking delivery actually notifies the Comex that it wants to remove the bars from the Comex vaults and move it to a private depository. And because until that event happens, you don't know if that silver is actually really in the vaults or not. It doesn't have to be. As long as the investors agree to leave their delivery in the Comex vaults, it's in the custody of the Comex or the vault operators, which are primarily the banks. There's some private vault operators, but it's in their custody. So, and they know that unless you ask for delivery, they don't have to deliver the bars. In my fund in mid 2009, we asked for delivery of silver, and technically, we're supposed to be able to send a truck, within 3 days after the final delivery day and remove the silver. Well, we weren't allowed to do that until 6 weeks after the final delivery date. So, just from personal experience, I've learned not to trust the numbers that are reported by the Comex. Now, I do agree, though, that the number of contracts, number of entities that are standing delivery certainly reflect an increasing desire of investors to take delivery of the metal. But my advice to them would be to remove the bars from the Comex, and that's when I think we'll really start to see fireworks in the market.
Yeah, and to add to that, I think Dave's correct. And it could be, if you look at who basically runs the futures, the banks know, they have all the data, right? So they could just be exchanging with one another, paper exchanges where the metal sits there and then it goes from one account to another. And that's kind of like a wash transaction in Bitcoin, where you're basically washing the price up by doing trades between two accounts. That happens a lot. So yeah, they do have to take it off. So the second thing you look at is how much of the overall inventory is left in the Comex. And I think that's where a lot of people feel as though the numbers are not correct. People feel as though Comex may be misreporting the actual physical stocks. And I've heard this whispered about several times. I've never seen any actual data saying, or an audit saying that their stocks are not correct. But a lot of people feel as though Comex may not be 100% honest about what they actually have. And maybe that's why it took Dave 6 weeks to get his medal out.
Well,
Dave,
there's a
where's that
Ronan Manley dug up a letter that was buried on the CME website, and it was written from the CME to the CFTC, and the letter said, we're just letting you know that as much as 50% of the gold that is listed as eligible gold in our Comex vault positions may actually not be there to be delivered.
And Dave,
and you can go to bullionstar.com to dig up the article. It's fascinating, and it was great sleuthing by Ronan.
and you also found that disclaimer once where they said you can't take their data as accurate, which I thought was funny. Although just so that
Kind of pathetic.
just at least for anyone who wants to know where you can look up at least what they're reporting. I look at the daily here often. That's the one that you saw a moment ago. Shows, come on, internet. So this shows the daily saying in the last day, 1,800 more gold contracts, up to 43,000. Rest of the contracts a bit slow. The year to date is interesting because then you can see, here you can look month by month and see that. And I think Dave quite wisely points out we're not seeing necessarily metal leave Comex, but everyone thought 31,666, interesting number, was a big one. Then you have 55,000. Now we're up to 43,000. And the last thing here is you can actually look at, here's the gold stocks. It saves as an Excel sheet, which, but anyway, those are three of the things.
And this is the part that gold stocks is really the key to the whole enchilada. Are those gold stocks, is that spreadsheet actually correct?
Are the bars there or not?
Yeah, having been an auditor for 15 years in technology, I learned very quickly that what people say is often not what the truth is.
Shocking.
Just a little bit of digging.
Especially with the banks.
Right. Just a little bit of digging, you find the truth. So just because it's out there doesn't necessarily mean it's true. But to be fair to the market price, that's what drives the market price. People look at that data and that's how they view the market. The scandal will come if and when it's found out that it's not there. So how much of a Ponzi is this really? So we believe the GLD and SLV are Ponzi's because when I spoke with Nick Bereshev, who Dave Morgan calls the smartest guy he knows, talk about how the GLD and the SLV are dealing with leased gold and silver and they don't own it and it's leased from central banks or other large entities. That's a Ponzi because you're basically buying the same gold or silver more than once.
Yep.
And is that going on Comex? Potentially, we don't know, but I'd like to see a real third-party audit of that and somebody go in there and validate that they actually have what they say they have.
Yeah. So Rob, I think I seem to address Saeed's question directly and to show you what I see as a potential trigger to this. There's the date to watch for on the Comex, I think for gold at least, is November 29th. That I think is the first delivery date for the December contract. And the December contract's the next active contract. There's not going to be much movement in September, October, November. It's those contracts are not so active. But the December contract will be. But I think the trigger to this uncovering this Ponzi scheme, if it is a Ponzi scheme, or like a fractional reserve scheme, which is the entire global banking system, could be if the Comex pulls what it did in 1980 or 2011 with silver. In 1980, they basically shut down opening new positions. And on January 21st, 1980, Comex said you can't buy any more silver contracts until you close out. And they were trying to smash the silver price down because it was getting out of control and it was endangering the dollar existentially. In 2011, I think they increased margin requirements sometime in late April around the silver top, and then silver just kind of got smashed. They just changed the rules mid-game. So the question I got today from some of my readers was, could this happen again? Yes, it could. Comex could change the rules if gold and silver get out of hand. But this time, once they do that, then they're challenging the open interest to run them, because they're going to say, oh, you're changing the rules now. Now I want my silver. Give it to me right now. And that's when they're endangering their entire operation. That's what that could default Comex, and that could expose the fund.
Yeah, that's a key important point. The open interest, why I brought up earlier, there's a massive amount of open interest, especially in silver. I mean, it's just, if you compare open interest in silver contracts to any other metal on the exchange, it's just unbelievable. And I don't think they're going to be able to get away with exactly what they got away with before either. I think somebody's going to hold them accountable. I think the market's holding them accountable.
Yeah, and that, I guess to Saeed's other question, I'm particularly intrigued by the September deliveries, which I don't know the exact date for, but will begin the end of this month. And I guess I never answered the $100 silver question before. I don't know that I would think that would be possible in a normal world without futures contracts, but my guess is that when, if we really do reach the point where there's some sort of force majeure or some sort of cash settlement, however they do it, that would be the scenario in which then it's like, if you settled your 28 or $30 on Friday and then you open up and what does it cost to actually get an ounce of silver? And will we see that soon? Who knows? But that's kind of what I think would precipitate something like that.
So question here, general economic question for people on the app. Is money velocity the key to hyperinflation? Maybe Rafi, I'll direct that to you.
So money velocity, it's kind of a meaningless calculation. I think it's a GDP over money supply. But the problem is once you get to hyperinflation, it's not, so money velocity is really an effect of hyperinflation. It's not the cause. When people suddenly realize, when the public suddenly realizes that the currency is losing purchasing power, it's not that commodities, it's not that the prices of things are going up, it's that the dollar is really tanking. Then they start throwing dollars away at anything that they can buy. This happens in every hyperinflationary economy that's ever existed. So once you have that, then yeah, money velocity goes up because people are exchanging things. But GDP, it's really a fake. It's just a calculation of every dollar transaction in an economy. But if the dollar isn't worth anything, then the amount of goods that are being exchanged for those dollars that are being transferred over and over again is very, very small. So I would just ignore money velocity. It's a meaningless calculation. What you're looking for is a recognition from people that they have to get rid of money as fast as they get it. That's going to come with food prices rising. Food prices are rising very fast.
Yeah, and unlike like you said there, Rafi, the Austrians were quite clear about not being buyers into that money velocity. I see Jim Rickards claims the comment. Jim Rickards claims velocity and money supply is inflation. I would dispute that. The Austrians were quite clear about that, where you create credit, that's your inflation. And, to the people who say, well, we don't have a $10 loaf of bread or a $50 slice of pizza yet. I mean, I don't know. I don't know we're that far off, but a lot of the inflation, A, has been exported, and B, I mean, I'll bet anyone who's in their 20s and just got married and thinks maybe it'd be nice to live in a house sometime in this lifetime, they're probably not appreciating the great gift and the circle of virtuosity that Ben Bernanke bestowed in the housing market, where you have a ton of money that's gone in there. Look at the price of Tesla shares. The NASDAQ somehow, I'm confused. I thought we had a pandemic that was shutting down the global economy, yet NASDAQ stocks are at all-time highs. So I would say people might want to consider that you could have the stock market go from 29,000 to 25,000 and still have massive inflation in there, because without all of the Fed's printed money and credit, it might have gone down to 10,000 or 5,000 or something like that. So there's plenty of inflation there. It's not distributed equally or simultaneously on an equal rate, but it's there. And yes, I would dispute Jim Rickard's view that, and I know a lot of people talk about it, and I'm not saying that, and who knows, maybe they're right, but yes, that was something found the Austrians were quite clear on, and when you read why, that made a lot of sense to me.
I mean, inflation, the economic definition of inflation is the devaluation of the currency. And the currency becomes devalued when the increase in the supply of the currency, or the currency increases in supply at a greater rate than the wealth output. That's your definition of inflation. Prices rising are evidence that inflation has already occurred. We've already had massive currency devaluation go on since 2008, and it's shown up in and the price effect of that has shown up in a lot of different places. Maybe not necessarily at a hyperinflationary price rate in maybe food, but what about things like insurance, college education, automobiles, housing, art, fine art, things like that. That's where your inflation, and obviously, the most obvious one is in the financial markets. That's where your inflation has shown up. And I think that this next cycle of monetary inflation it's going to show up more quickly in things like food price inflation and gasoline price inflation. So that's the thing that, people kind of generically talk about inflation, and they think that, it just means, well, the pound of ground beef I bought last week is about the same price this week. So show me where there's inflation. Well, that's not what inflation is. And by the way, the pound of ground beef that I'm buying this week is double the cost of what it was 10 years ago. So,
Yeah,
we're in the middle of a pretty high rate of inflation, and the CPI is not designed to measure inflation. It's designed to be a political tool.
Yeah, I mean, especially now since these lockdowns, the CPI statistics have been even more warped.
Yeah,
half the stuff in the CPI is effectively illegal to buy. I mean, not literally, but like in March and April, getting a plane ticket was illegal because you couldn't leave your house. Buying gasoline was basically illegal because you weren't allowed to drive anywhere. So like, what do you expect when the demand for things goes to zero? What do you think is going to happen to their price? The price of garbage that you can't use. Remember in April when the price of oil went like negative $35 on April 20th? Well, that's because there was nowhere to put it and no one was using oil. So the price of garbage, even in a hyperinflationary economy, it's still zero, but that doesn't mean anything about the dollar. I mean,
right. That's a good analogy.
So question here from Ilkson. How exactly our physical metals would protect us from inflation, like home prices go up?
If I may, Dave, I think it was in one of those JP Morgan or Goldman Sachs articles we were giggling at last week. I was reading something where they were saying gold hasn't been a good hedge for inflation. Someone actually criticized gold for not being a good hedge for deflation, which I don't think it was supposed to be, although given the current spot we are in the interest rate cycle, I think it's a hedge for both, because if they ever tried to take the credit away, you'd melt down the banks and we'd probably be scrambling for gold and silver anyway. But I mean, I guess you could make the case that, has gold been a good hedge for inflation over the past 9 years where the credit has gone rampant and gold and silver got pounded, well, at least until the last couple of months? And Dave, I'm at risk of poking the bear here. I get what people are saying when gold is money and should be money, although, even as perhaps world's biggest silver bull, I realize we're not using it as money right now. They did take it out of the coins. And in terms of keeping up as a true hedge of inflation in recent years, that has not been the case. Now, that's why again, markets, there's what should be, and then you realize it's like a poker game. The guy maybe shouldn't play the 2-7 offsuit, but when he flips that over and then you get rivered at the end, well, he did. And you have that same dynamic going on here. So I don't think it's going to track inflation one for one, but my strong belief is that if you're holding on silver, especially when, I wouldn't orchestrate a Ponzi scheme with our most valuable assets, but that's what the banks and governments have done. And by the time that unravels, which I think is a matter of inevitability, we may be seeing part of it happening now. Then hopefully you have a bunch of ounces of silver, but when you want to buy a house after that crashes in real terms and silver is soaring, you're going to pay much less in terms of ounces. Although even with that said, as fast as things have gone up, what is gold's up 7 or 8-fold since the year 2000 now. And might be 9-fold by the time we finish this call. So, keep that in mind. It's not probably going to be in a human world any perfect, but at the same time, I wouldn't go buy tips or something like that. That's based off of the CPI formula. That I love my favorite find of the last week. The only two means of deficit reduction I've ever heard of in my entire life. I'm about to be 42 next month. We have the debt ceiling, the Tea Party, and all this. The only two plans I've ever heard out of the government were when Obama and CPI advocated rigging the CPI formula, or back in 2013, he actually came out and said, as a means of debt reduction, let's change the formula again so we can steal from the retirees and senior citizens. I don't even think he realized what he was saying was accounting fraud. And then the only other plan I've heard was to mint $1 trillion platinum coin, which I thought they were joking about, but actually Congresswoman reintroduced that proposal earlier this March. And I'm told we live in a little bit of a wacky world, and I get when people are tired of hearing about manipulation, although I find as much as you can shift that mindset, similar to what it seems like the Chinese must be sitting there thinking like, wow, these bozos are really going to let us drain their gold at subsidized prices. Okay, we'll keep buying it. And, when it can't go anymore, just like, remember, for anyone who thinks the banks are bigger, even JP Morgan got their pants, caught down in 2011 with their London whale. So when you reach that point where there's blood in the water, I think that's the history of markets. That's how nature goes.
All right. First of all, gold has been a fantastic hedge for inflation. Maybe not over a 5-year period because of manipulation, 10-year period. Let's look at 1971 to now, all right? I was alive then, I'm alive now. And you hold gold to preserve wealth. And the wealthy families that have lasted with their wealth for hundreds of years, they pass down their gold from generation to generation, and that's why they keep their wealth, all right? In 1971, you could buy a Cadillac Eldorado for $3,000, all right? The price of a Cadillac Eldorado now is, say, $75,000, so it's gone up 25 times. The price of gold in 1971 was $35. Now it's $2,050. It's gone up 58 times. So, in fact, you can buy twice the amount of Cadillacs with the gold now that you could buy back then. Okay, here's another example. The house that we moved into in 1970, my father paid $45,000. I think he only used a 50% mortgage, which is how people did it in a rational world. Back then, it would have taken 1,265 ounces to buy that house, ounces of gold. All right, fast forward, within the last couple of years, the house traded for $650,000. However, it would only take 317 ounces to buy that same house. So you tell me how gold hasn't preserved your wealth and hasn't been a great inflation hedge, because there's two items that people spend money on every day that have been more than hedged by holding gold over the last 40 years.
If I may point out this exciting historical moment, Dave, you were actually alive when gold and silver were still being used as currency. Isn't that right?
Well, they weren't necessarily being used as currency, but there was a partial backing of the dollar and per the Bretton Woods agreement.
Were you here when LBJ, who I hear was far from the nicest guy on the block, took the silver out of the coins?
I would have been alive, but I certainly don't remember it.
Wow. Well, you're an artifact, and I'm excited for your knowledge.
So I wanted to say something about two things about housing. First of all, if we just try to think about this logically for a second, we have much better capital equipment than we did in the 1960s, 1970s. We can build a lot more houses a lot faster than we used to. So really, housing should be much cheaper than it used to be, and you can see that in the ounce, the gold ounce price of housing. It's gone down, as Dave pointed out. The reason that housing prices are going up is because of inflation, because they keep skimming off the top of our money. So again, we have to think in terms of real money and not in terms of dollars. I mean, the only reason that the dollar can buy anything at all is if we go back to Mises' regression theorem, that money has to come from a commodity in the beginning, and the reason it has exchange value now is because it was directly exchanged in the past. There's a link there. So the only reason that the dollar still has any exchange value at all is because it still can be exchanged for some amount of real money, which is gold. Once it can no longer be exchanged for any amount of gold, then the dollar is dead. It can't buy anything at all. And that's really when gold will save you from inflation, because it is money. You need to hold some amount of real money. You also need to hold some amount of dollars because you need to pay taxes, but other than that, you don't really need them.
All right. If you guys don't mind staying around for a bit, people have been really interested in stocks today. A lot of we've been talking about before you guys joined. Which stocks are you in favor of? Gold and silver. Dave, you want to start us off? What are you looking at? Do you prefer gold and silver stocks? Do you have any names for people out there?
Ooh. Well, as you know, I publish the Mining Stock Journal, and I try to keep my ideas, or at least my new ideas, proprietary to my subscribers. So, just generally, I think that silver is going to outperform gold. Mm-hmm. And so I think over time, good quality silver stocks are going to outperform good quality gold stocks. And I think you have to be careful when you're looking at the market, because there's the established producing stocks, and those are gonna say over the next couple of years, those should outperform the price of gold and silver. You're gonna get the benefit of the leverage to the gold and silver. And then there's what I like to call them are the micro cap venture capital junior exploration stocks, and those are typically going to be companies that are just starting out to try and develop a property into an economic gold or silver deposit. And I try to look for companies that have a market cap under $20 million, because if you can pick out the right ones, and believe me, if you pick out enough of them, you're only going to pick out a couple right ones of the right ones, but those right ones, the gains you'll make on them will more than make up for the losses that you suffer on all the other stocks. That's why, that the other juniors that don't work. That's why Eric Sprott's doing what he's doing. Of course, he's hoping that every investment he makes is going to work out, but he knows that statistically it's not, especially when you're investing in the juniors. So, but some of the names that I like right now, and again, these names have run up a lot. So if you buy them today, they might be lower next week or a month from now. But I think that if you buy a little bit now, and if they save cash reserves so that if the market does pull back, or when it does pull back, you can add to the position. That's where you really are going to make your money in some of these names, because the names that I look at, although I can't predict, what price path they'll take, hopefully between now and 2 years from now, they'll be a lot higher than where they're trading now. So, some of the names that I recommend in my mining stock journal, and I also invest in my fund, would be like Millrock Resources, and they're working on they have a joint venture partnership in what is potentially going to be a very lucrative gold deposit in Alaska. And it's a 20-cent stock, and this is the kind of stock that I think, if they make a discovery, and that's a big if, it could be a 5-bagger in a very short period of time. Another one that I like, and I've mentioned it in my money stock journal, so my subscribers know that I've been buying it and that I like it, is Viva Gold. And again, it's already run up a lot. It's more than doubled since I first started buying it. But I think if all the pieces fall into place and the chips fall the right way, that stock could be a 3 to 5 bagger, and it's been largely de-risked. And so those are the names that I like, and I'm actually I'm doing an analysis of it's kind of a short analysis on Alexco Resources, which is they've got a very, very high grade silver project that they're going to start producing from by the end of this year. And I think, with the prospective exploration upside on the property that they have, because they've already found 3 deposits of very rich high grade silver, and they've only explored 10% of the project. I think it offers, even though it's going to be producing soon, it offers the type of potential upside that you would find with a less risky junior stock. So those are 3 names that I like a lot right now.
Okay, so we're past the 90-minute mark, guys. I'm going to go ahead and let the presenters go if they need to run to other appointments. Wanted to thank everybody, Rafi, Chris, Dave, for joining. Everybody else has joined as well. If you guys want to stay on, you're more than welcome. I'll be on until about 5 p.m. So if you guys have questions for me, but please give our presenters a big thank you for coming and spending their time with us at the conference.
Thanks for having us on, Rob, and thanks for organizing this.
Absolutely. It's been my pleasure. Thank you.
Well, there you go, folks. That is today's show. You got to hear Denver Dave Kranzler and myself and a few others field some questions. So hope you enjoyed that. Hit the subscribe button and the notification bell. That way you can stay posted as we have more fun stuff like this released. And to find out a little bit more about what is happening on the wholesale and retail level in the silver market of the physical market, well, this week's call with Andy Scheckman and Mile Franklin is coming your way now.